Good morning, ladies and gentlemen. On behalf of the Federal Authority for Government Human Resources, I'm pleased to welcome you to this year's third Human Resources Club event. Our session today will be about empowering women in the investment world. Women have made advances around the decades. They made major steps forward in different fields. Investing in women is not only the right thing to do, it is the smart thing to do. In today's session, we're hosting Ms. Nandini Joshi, Chief Operating Officer at Stashaway. Now, let us welcome Ms. Nandini.
Thank you very much, Woad, and thank you to everybody joining today and having Stashaway and myself. We have about 60 minutes together. I will go through some slides that hopefully will help you either take your first step towards investing or help you get deeper into it if you have already started the first step. Please feel free to use the Q&A to write down, as there are many participants we won't be able to unmute, but I will, after the presentation, go through all of the questions as well and try to answer as much of the Q&A as possible. So having said that, just very quickly about us. As well shared, I'm the COO at Stashaway. What Stashaway is a digital wealth manager. So we are, it's been about a year plus that we've been in Dubai, but we are originally from Singapore, and across Southeast Asia and MENA, we manage over $1 billion. Really the pain point, came from empowering, people like you and me to be able to invest and be able to invest better. So I'll go through a few of the things today for investment in general, but also why investing for women is really, really important. So just on the Stashaway, as I shared, we are a digital wealth manager, and we are regulated by the DFSA in Dubai, but also by 5 other regulators in Singapore, Malaysia, Hong Kong, and Thailand. One of the things that we do have on our app that you can download, whether you are an investor or not, we do have a lot of academy courses, so a lot of free resources for education. So please do take advantage of it. And along with the app, we also host a lot of public webinars, regularly, as well as publish content, and I have a podcast which helps people exactly understand investing. So a lot of things that you can find out, maybe more nitty-gritty for yourself. Again, all of these resources are available for free. You do not need to be an investor. Just download the app and be a user, and you can kickstart your content journey and learning journey. So why did we create this seminar, and what are we really trying to achieve? A few stats. As you can see, the share of wealth held by women is still a really small number. While it might show some of the other regions being higher, but when it is compared to the overall wealth in the world, women still hold not an equal share, and therefore there is still a lot to do, and definitely in the region where we are at the moment. And where does it start from? It's really from most women are not involved in financial planning decisions. So for example, in the GCC, 92% of women say they leave their spouse to lead all financial planning decisions. While women may sometimes be more involved in the cash management on a day-to-day basis, that does not actually equate to long-term financial planning, which also has a huge impact on them. So a key reason why women decide to leave it to someone else and step aside, one of the biggest reasons is that they think they don't know enough about this topic to actually make the decision. And that's what, this seminar is really meant to, is to actually demystify, what you really need to know. And actually the fact that it's quite simple. We have been made to believe that it's a very complicated topic, but it isn't. Personally, I don't come from finance background. I come from an engineering background, but it is, fintech was a space that I stepped into. And so, there is a very easy way for all of us to actually build our knowledge. And the second part is that, across the world, but, a lot in Asia and also in GCC, most women will outlive their partner. It's a fact of life. Women have higher longevity rates, and therefore it's really important to make sure that we are not taking a backseat when financial planning is concerned. So, and again, we talk a lot about gender pay gap, but the overall wealth gap has two aspects, which is the pay gap, but then as well as an investing gap. And so today, we really want to cater to the investing gap. So what can we do is to really start by taking control. And just to start off, it's really important to know that when we do take control, we actually outperform men in investing. And we'll go through why women outperform. We say because women tend to be long-term investors, and they tend to actually trade in and out less than men, which creates actually a better return over the long term. And we'll go over why those things are so critical, and actually women are inherently better at managing it. So a question that usually comes up is, are women more conservative? And right now, if we see how men invest versus how women invest, men tend to be a little bit more aggressive. So they tend to say their risk profile is higher. But actually, I like to think of it more, and data supports it, considering that women outperform men in the long term. Actually, this data shows that women tend to calculate their risk better than men, because it makes it that women don't trade in and out, which actually is what habit that creates long-term wealth. We are more, goal-oriented when we are investing. So a higher percent of women think about what is the exact goal they are investing towards, which is again what impacts them staying invested and reaching the goals better. So whether it's retirement, whether it's buying the first home or the emergency fund or any other type of goal. So how do you really get the most out of your savings? There are three parts to it. One is to actually set your goals, make sure that you are hitting the savings first, and then investing it. So today, what we are going to cover is the part of investing. And so the few points which are really key to investing are the understanding of asset classes. How much risk should you take? What does diversification mean, and why does it help you? Fees, they matter a lot. And should you try to time the market? This is a question that we get asked a lot. So we'll be going through over the next 30 to 40 minutes on all of these topics. So let's start with asset classes. So maybe if you can put into the chat, how many of you know what equities and bonds are? That would help me just understand a little bit better where everybody is, and accordingly I can share. Just yes or no will be fine. I see some yes coming through, maybe a few no's. So just going through what these are basically asset classes, and we'll go through what they really mean. So just in very simple terms, asset class is something which are like-minded holdings that you can club together. So for example, the simplest asset class is real estate. Within real estate, you may have residential or commercial real estate, but any building that you can own, put to rent, have an income from it, anything which is a building in itself is essentially real estate, whether it's industrial, commercial, or residential. Equities are asset classes that allow you to own a part of a company. So if you own a Facebook share, that's an equity. So this is companies basically allowing people to own part of the company. And therefore you ride up or down the performance or the outperformance, underperformance of the company, and you gain value to your overall investment with the value of the company going up in general over long term. Bonds are money that you lend to somebody, in this case, either a corporate or to a government, and are promised a rate of return in lieu of lending that company. So you are not an owner, you are actually lending. So to corporates, you lend for their working capital requirements, and to the government, you lend, for all infrastructure that governments might do. Usually when there are big projects that governments take up, or policy decisions, or building, infrastructure, they will try to raise funds by putting out government bonds, but there are also, evergreen government bonds that run. And therefore, this is about you being a lender to a corporate or to a government, and they promise you a certain return. As opposed to equities, where you are buying into the company and you are a shareholder, and therefore the company doesn't promise you back a return, but you invest in them because you believe that these companies will do well over the long term. So the risk is very different. In bonds, you have an interest rate that is predetermined and you are aware of it going in. Then you have other asset classes, for example, like gold and commodities. I know gold, again, in Asia is a very, very popular asset class, which people feel over time goes up in value, but you are essentially, holding that gold as part of your portfolio. So it's an investment that you make. So these are all different asset classes that you may work with. And we'll go through how actually should you be thinking about putting them together into a real investment strategy. So they all have different risk profiles. I think this is a really, really important thing to remember, that a lot of times you may be told what is the potential return. It's impossible to talk about a return without the word risk along with it. Because as you can see in this chart, I think some words are not popping up, but the extreme one is on the stocks. The risk on stocks, as I said, which are equities, and you are holding a share of a company, means you have to believe in how that company will perform. That has an inherent risk. There could be different things that could happen, macroeconomic, whether, what happens to their management, are they really in an industry that is booming, not booming, tech revolutions. And so you take wild stocks, and the stock market might have a higher potential return. It does come with a higher risk as well, as we saw in 2020 in the COVID crash. And I don't know if some of you were already old enough to remember the 2008 financial crisis. I was, and as well, I was old enough for the 2000 dot-com bubble. So quite a few, market crashes that, at least personally, I have lived through in my working life. And so inherently, every return has a risk associated with it. And it's really important to not decouple the two, because that's only not only half a picture, but you might actually make decisions that are not in your long-term welfare. And as you see, going towards the other extreme, where the risk is very low, which usually sits with government bonds, the expected return is also lower. And so it's important to know where, the asset class is on this risk return profile. And please, do not allow somebody to talk to you about a return without explaining to you what is the risk that you are going to be taking along with it. So in this, as you can see, cash in your bank is zero risk. If we are, all living in countries where banks are well managed, cash in your bank, you can take in. It's not going to earn you anything or earn you very, very little, but you won't lose out on it. Your risk is almost zero. Then you have, for example, bonds. And even within bonds, as you can see, between inflation-protected bonds and all the way to emerging bonds, which emerging bonds could be bonds from emerging market countries, that are heavily investing into infrastructure, you can see that already the risk profile changes. And why does that risk profile changes? Because you have an interest rate premium, which is determined, but then you may have higher return because there is the premium because you're taking a risk on the inflation then. Inflation linked between inflation protected bonds and nominal bonds, you get a premium up because they are not specifically protecting you from inflation. Corporate bonds, as opposed to government bonds, have a credit premium because now you are having to put your money into a corporate that has different rules of operation than a government may have. And therefore, even within a bond structure, you can see there are different levels of risk that you may be taking, and you have to be aware of the breadth of it as while you're looking at the return profile. And then, of course, if you go into equities and you think about large cap equity companies, like Apple and all, they have a different risk profile, whereas, there are companies which are on the stock market that are not as large as Apple or Amazon or Berkshire Hathaway, but they are smaller companies, and therefore, you may have certain risk related to them, but you may also have a risk related, for example, to liquidity. Is there enough transaction happening for those stocks so that whenever you do want to sell your stocks, you will find an immediate buyer? Tomorrow, if you have to sell the stock, of Apple versus you have to sell the stock of a small company that not many people have heard of, but is still on the stock market, you might not find a buyer for your stock as fast as you would like. So even within bonds, even within equities, there are risk profiles to be differentiated, and it's a question that you must always ask. So now that we know the asset classes and the risk that can be attached to different asset classes, how do we decide our own risk? We suggest looking at two factors, which is your timeline and your personal risk tolerance. And the most important thing to know is that when you look at these two pieces, it means that looking at where a friend or a family member is investing and following them may not be the right thing, because your timeline and your personal risk tolerance may not be the same as theirs. So why timeline is important? So this is a chart for equities, and bonds over a fairly, long 20-year period. And both, let's say we have two goals which have a different timeline. Goal A has a shorter timeline of 3 to 4 years, and maybe, it's because you want to buy a house, whereas goal B has a longer timeline, which is maybe 20 years because you're thinking of retirement. You could say, if I put all of my money into equities, and my goal has a shorter timeline, I actually take a very high risk by putting all of my money in equities. Because as you can see over here, by the time I really needed that money to buy the house, actually the market went down. Whereas if I had put all of my money into the bonds, even though the market went down, I went up because I'm catering to the risk that I can take in that timeline. But if I have a 20-year timeline, and if I put all of my money into the bonds, as opposed to putting it into equities, I leave a lot of opportunity on the table. And therefore, timeline is really important to think about. But it's not, the answer does not have to be all in bonds or all in equities. And this is where, an investment strategy really comes to life, is by saying, how do I split my portfolio? So if we look at very simple 50-50 between stocks and bonds, or I'm sure a lot of you have heard about the 60-40, where, people say, oh, for the long term, put 60% in equities and 40% in bonds. That's been a very long-term standing investment strategy in the world. Already with that, where you would be in a shorter timeline versus in a longer timeline actually changes. So putting the various asset classes together to really cater to your risk profile is important. And this is something that, obviously on the Stashaway app and in our investment offering, we do that automatically for you and show it to you that you can then confirm. So just to share, on an average, a retirement goal on our app, people look at it for on an average for 24.2 years. They look at building towards their retirement. They look at keeping their emergency fund for 15.8 years on an average. This is probably very linked to, by the time, you don't have to pay for kids anymore, they are old enough, or that you are actually, you are not anymore putting in jeopardy your retirement goals. Child education funds usually have an average of 12.5 years of goal. So as you can see, every goal has a different timeline, and it's really important to make sure you get that timeline right. And then therefore there are different risks and your, risk tolerance. So you may have, for the same person may have a different risk profile for a shorter timeline goal versus a longer timeline goal. As you see over here, to buy a house, Rachel may say, I want a 50-50 portfolio between growth and protective assets. But I'm going to be retiring in 30 years, and I can afford to be a bit more aggressive over here, because over a 30-year period, actually growth assets always outperform, and they are able to go through market corrections. But you need to know what risk tolerance you can take, because staying invested through the ups and downs of the market is the most important thing. And I'll share a couple of charts later on to illustrate that. So now we come to risk tolerance. So again, like I said, same two people for the same timeline and same goal might actually have a very different risk profile, because your risk profile is really attached to when the markets go up and down, what is not gonna make you, either put you in a financially difficult situation or just lose sleep. And that personal emotional impact is not to be underestimated, because over the long term, it plays a huge role. And like I shared before, that's why men tend to actually trade in and out far more than women, because they always assess themselves to be more aggressive in their risk profile. But when, the markets actually show volatility, they tend to trade out. And as some of you might have seen, since early this year, the markets did correct, and especially very, very, tech stocks that have been very popular over the last 2 years have actually been corrected quite a bit. But again, this is not a new phenomenon. The market does go through it, once in every few years. So, which is why we come to diversification to now manage your risk profile. So how do you diversify personally for yourself across your timeline, as well as your risk tolerance? So it's not one solution fits all, and it's not also one solution fits all goals. And why it's very important, because it's simply, not putting all your eggs in one basket. So over exactly the same period of time, as we spoke about the different asset classes before, you can see over 2 years, US commercial real estate how it performed versus how gold performed. So if you're somebody who had all of their money in US commercial real estate, those 2 years were not a great time for you. If you were all in gold, might have been a good time, but as you can see, there are dips also that happened within that. But if you're somebody who had actually put in 50% or 40% in one, 60% in the other, thinking about the timeline of your goal, you would actually have a very different reaction to the performance of those asset classes. So what we want to look for in asset classes are the ones that are not highly correlated, which means if one goes up, the other also goes up. But if one goes down, the other also goes down, which means then a larger part of your portfolio comes down. So this is one of the things that in our investment strategy, we pay a lot of attention to, and we work with non-correlated asset classes so that you can really, ride out the ups and downs of the stock market that can sometimes be very volatile. And so what a diversified portfolio may look like is that, not just what equities and bonds is, but as you see within bonds and within equities, there can be even further splits, right? From a geography perspective. So US equities versus European equities. From size perspective, as we said, so small cap equities, which means companies which are smaller in size versus large cap, which are your Apples and your Amazon of the world. But then, also from a sector perspective, so consumer discretionary means, things like shampoo and, lifestyle products, which are discretionary products that people can cut out easily, or non-discretionary products like food and all that people might not actually cut out when things are going well or not going well. But also sectors like healthcare. And similarly in bonds, you may have, government bonds versus emerging market bonds, and then, things like gold or other commodities. So a diversified portfolio really looks like a balanced portfolio, first at a growth and protective asset level. So equities are growth assets, bonds are protective assets, but then within them also a sub-asset class level that you can really diversify, based on geography, sector, size. So this is a very simple example from actually the Stashaway app, just to illustrate, what things could look like. So for example, a university fund that may have, on an average 12 years goal period. As you can see, the the blue, these are equities. The dark blue is US equities. The light blue is international equities. And then you have some fixed income, you have real estate, you have government bonds. Here's an example of an early retirement fund. If you say, oh, I want to create an option for myself to retire, I don't know, in 5 years or 10 years versus my actual retirement, long-term retirement fund that might have a 20 or 25-year horizon. You can see over here, then the blue parts of equities actually become smaller, and the government bonds and the commodities and the fixed income, they take up more space. And a really long term, around the 25-year time horizon might really give the light blue and the dark blue, which is heavily towards equity, as we said, over the long term, they really tend to perform. But knowing that there is a risk of volatility that you take along, which is why they are better suited for 25-year time horizons and not for 3 to 5 year time horizons. Coming to fees, they really, really matter. I mean, if you see on any prospectus, there is an entry fee, there is a management fee, there is a transaction fee, you definitely know there is a fee that you actually can't even read over there. So please be very, very careful about reading the fine print. And if you're working with a financial advisor or any platform, really ask them to list out the fee. And if you don't find the answers to a clear answer to what fee you are paying, run fast and run far. And why this is really important. So really easy math, over a 30-year period, if two investments had exactly the same money being put in, their risk profile return rate is exactly the same, but the fee, so 0.2 to 0.8% of AUM annually is what is the stash away fee. So it starts at 0.8 and it goes down for higher funds. And a very, market, for example, for unit trusts and mutual funds, a very typical fee is there is usually an entry fee, and every 2 years there is, which is actually charged every 2 years, and then there is an annual fee. And an entry fee usually ends up being about 2.5%. So, if that essentially means that if you give $100, actually 2.5%, so $2.50 will immediately go into a fee, and you actually only invest, 98 and $97.50 even to start with. But when you accumulate that, so if that fee is not being taken out, but is actually you are paying a lower fee and you are actually putting that money back into compound interest, over a 30-year period of just putting $2,000 away every month, that difference equates to $600,000. And I'm sure if our last name is not Rockefeller, $600,000 makes a difference to a lot of us. But already, as you can see in this chart, even at 10 years, it can create a delta, and this is just your money that is not working for you. So if you do agree to pay that level of fee to somebody, make sure that you understand the value that you get out of it. Because if you're not getting a value that is different from other options that are now available in the market, what you're paying in the long term is actually $600,000 and not just that 10 or $15 that 2.5% in the beginning might make you feel. So please pay a lot of attention to fees. Should you try to time the market? This is a very, very common question. Now the market is down. I don't want to invest. I don't know how it will work. Now the market is too high. And so is there ever a bad time to invest? This is a very simple chart to show how if you had $10,000 and if you kept it in 1990, if you left it all in cash, where would you be in 2015? So which is a very typical timeline of retirement. And in 1990, there was a small correction. And if you had badly timed it versus if you had well timed the market, you can see how little the difference is. And as you go further, the difference can be in 2011, which is much closer, the difference can be so small. But as you see, the cash really doesn't grow. And this is really because over a longer time period, the equities markets always will outperform any other, small corrections that you may have over a shorter period of time. And so also the difficulty in timing the market is that historically it has been proven that the best days and the worst days are very, very close together. So you have to be a very active trader, but really that being your day in and day out job to be able to time a market well enough to actually make a meaningful difference. The second part to it is listening to the media noise. And this is just the market over 10 years, how the S&P 500 has performed. And as you can see, the market goes through, some ups and downs along the time. You can zoom in, you can zoom out. It can be a very personal picture. But as you see, the news that comes out sometimes in the media, oh, now the economy is really at the worst. This is going to double dip. We are into a global recession. We are now going to go into a 7-year slump. And if you had at any point of time, taken your money out, basically what you would have missed out is over 2 years, tripling your money by just leaving it there. If that was your retirement goal and, you had to be invested over 10 years, and this is why it's really important to know what is your risk profile. to just stay invested. The market at the end, always in the long term, ends up winning. The difference is that the media's job is not to keep you invested. The media's job is to sell tomorrow's paper. So we do have a lot of content that we create on a bi-weekly basis that helps you understand the market, that helps you, gain knowledge, and therefore, make sure that you risk profile yourself correctly to be able to stay invested in the right goals. Again, all of this is available free of cost. You can just subscribe to the newsletter. So with the long-term view, no, there is no bad time, to invest. I usually tell people the best time was yesterday, but today will be just as good. So it's a very famous quote by Warren Buffett: be fearful when others are greedy, and greedy when others are fearful. It's largely people who think they can outperform and who can smarten the market. The best thing is really to stick to your risk profile and make sure that you understand and continue to grow your knowledge to understand the fundamentals of it. So just quickly to recap, and then I will go to the Q&As, is choose your right risk profile on timeline and risk appetite, construct a diversified portfolio, watch out for the fees, make sure your investments are easy and flexible. If somebody tells you, oh, you are in a 15-year lockup, again, those are solutions of the past. You should not have to depend on such rigidities on you and still be giving such high fees to people. And we always recommend not to try to time the market. Very, very quick piece on exchange traded funds. So just like a lot of you may know about mutual funds or unit trusts, exchange traded funds are actually another way of investing. They are available on the stock market. We use ETFs. And we always encourage people, if you are also doing your, preparing your own investment strategy, to look at ETFs as the instrument, largely because they are very liquid. So you don't have lockups to deal with. You can take your money in and out whenever you need. They are very diversified, so you are not having to buy a single stock, but you can better manage your risk profile. And they are very cost efficient. So unit trusts usually end up being about 2.5%. Charge, and they usually have a very high expense ratio as well, which is, just the yearly upkeep of the unit trust, whereas ETFs are very cost efficient because they have usually under 0.5% of charge from the fund manager that provides the ETF. So if you're looking to build and execute an investment strategy by yourself, please do look at ETFs as an instrument. We use the same. And then, the asset allocation and then the securities selection are the two important parts, but getting your asset allocation right is the most important thing. So among, different types of equities, bonds, according to your risk profile. Before I go to Q&A, we actually do have an offer from Stashaway for all of you here today to try out. If you want to just look at it with as little as 1,000 dirhams, you can start with that. So you can utilize this offer on a dedicated site. It will give you 6 months of free investing for up to $40,000. And I've also left the phone number and contact details of our local support team. They are super helpful in answering any questions related to either Stashaway or investing in general. So please do reach out to them, as you try to take your next steps in investing. Feel free to take us up on the offer. So I will pause there and start to look at the Q&A. So I have somebody who has asked, can you talk more about cryptocurrency investments? Oh, it really is a hot topic these days. So Yes, cryptocurrency, and how do you compare it to other assets? So obviously, cryptocurrencies have a shorter, history. They don't as yet have that long a history, and they are highly volatile. So as an asset class, our house view at Stashaway is that yes, I think digital assets. We think digital assets do have a place in the asset allocation. But it's important, again, to make sure that you understand well what you're investing in. Bitcoin, Ethereum now have far higher market cap, so there is better liquidity. But as you can see, they also still go through quite a bit of volatility. So again, from your personal risk profile, can you handle that level of volatility? And therefore, our house view is to not cross more than 5% of your, as a retail investor, not cross more than 5% of your net worth. How you calculate your net worth is everything that you own minus everything that you owe, and that's your net worth, and not to cross more than 5%. If your retirement goal is already taken care of and you are not risking that, then you may choose to increase your investment in it. But as long as you have not completely secured your retirement goal, we would suggest not to cross 5% of your net worth. But then again, please understand very well, which cryptocurrency you want to invest in, what are the underlying, where does the volatility in it come from, and also what is the thesis for it. Some of them are for blockchain, some of them are for infrastructure, versus others are for utility. So what is the utility of the cryptocurrency, and therefore why more people would accept it. And that's the biggest unknown among the cryptocurrencies is the long-term view of a lot of coins today. I'll just try to go to the other questions. Follow myself certain steps till I reach the right. So yes, please think about how you want to best, think about your investment strategy. And the first thing it comes from is really what are your goals? Are you saving towards retirement? Have you already taken care of an emergency fund? If you haven't taken care of an emergency fund, please do that first. And also, if you should very much look at whether you have any high interest debt, like credit card debt and all, which again tend to erode a lot of value of your net worth. I have another question. I have invested in Ethereum already, actually, but I would like to know what is the ideal exit strategy for such type of investments. I cannot give individual advice, and this is the part I don't think, there are exit strategies. The exit strategy is really the goal for which you invested. If you invested it for a long-term goal, then stay invested, but know that the risk profile of cryptocurrencies, and including Ethereum still, is way higher than any equities risk profile. So today, actually, to retail investors in retirement goals, Stashaway does not provide cryptocurrency allocation. And a lot of regulators are also looking at how to regulate cryptocurrency for retail investors, because sometimes the risk profile can be very misunderstood. And so, for me, cryptocurrency is still a place where it shouldn't hurt your retirement goal or any other key goals, like buying a house or sending your kids for the education that you want, in case you lose it all. So it's still a highly volatile piece. So I'm afraid there is no way to tell you, which is the ideal time to exit. Any other questions that I can help answer at this moment? Oh, another question, which fields women should consider for investing? I think, so where at the end women or men invest is not different. I think what is really important is that women start investing and find an easy way to get into a diversified portfolio, because being in just one asset class can be very risky. So the first thing is to secure your emergency fund. So that may be 3 to 6 months of your living expenses. Make sure you keep it in highly liquid form. Bank accounts don't, savings accounts don't really earn you that much. We actually have a free product called Stashaway Simple, which is a cash management account. And I believe at the moment it returns, in MENA, it returns around 1% with no lockup, no fees, and is highly liquid. You can take out at any point of time. So you need to secure your emergency fund first, and then start to invest for the long term. Retirement is the most expensive goal that any of us have to save for our life. No other goal in our life is as crucial and as expensive as the retirement goal. So it's really important to get started on it fast. And Stashaway is one of the platforms that helps you start with as little as 100 dirhams. So you can gain knowledge through it. You can see, okay, I put 100 dirhams. Where did it go? I have, the pie chart that I had shared with you. It can show you, okay, you are in this much in this type of equities or bonds. You can really enlarge your knowledge just by kickstarting. Sorry, in medium field, so I did not understand that point. Not sure I understand the chat. What is the ideal portion of my salary that should be invested? So the first thing is that we recommend to people to try to get up to a 20% saving rate. If you are not right now at a 20% saving rate, start with 5% and slowly make your way up to 20%. And from that 20%, if you have other ways to ensure that your emergency fund can be managed, you can already start to put 50% of your saving every month into long-term investing. So the ideal portion starts really from saving, which we recommend to at least get to 20%. If you are able to save further than that, that's great. And from that, start by investing 50% of your saving into long-term goal. And then as you have taken care of any high yield debt, high interest debt, or also any emergency funds gaps, then you can slowly move to moving 100% of your saving into investment. And maybe then splitting it between goals if you have another goal that adds up. Otherwise, first, definitely try to fund your long-term retirement goal so that you can take advantage of the compound interest from early on. What advice would you give to future female entrepreneurs? I think I think entrepreneurship is such a personal exercise. But one thing is, whether you're a female entrepreneur or a male entrepreneur, I think one thing is really, really important is to be very, very diligent with your finances. Do not leave it, whether it's your personal finances during the time that you are taking up entrepreneurship, or it is your company's finances. If you don't feel comfortable right now managing it, get comfortable. Spend the time to get comfortable, because it's going to be the biggest lever that you have to be successful, and you would want to make sure that you keep it in your control. And yes, that's how you build self-confidence. Self-confidence really comes from when you have the critical things that are crucial to your success under your control, and you know how to utilize them. So both on your personal side, how do you assure? Because in the beginning you have perhaps not an income. You have to, till you can get the company to a certain stage. I think it's really important to know how you're not going to worry about your own personal finances during your entrepreneurial journey, especially early on, for it to not be a drain on your energy. But also your company's finances. I think it's very important to know how every dollar performs in your company. And again, that goes into, really understanding what is a P&L, profit and loss statement, what is a balance sheet, what does cash flow mean? I think a lot of people don't pay attention to cash flow. And I think it's really, really important to have a very tight control on cash flow to be successful early on. Is it invest a lump sum amount or invest a small portion monthly? Usually we always recommend dollar cost averaging, so investing monthly and going into the market. But again, it might be that, for example, you got a bonus or you sold a property and you have a lump sum amount. You can decide to invest that lump sum amount over a certain period of time. So say if you have sold a property and that's a fairly large lump sum, you might say, okay, I want to invest into the market over the next 12 months. Whereas your bonus, you might say, I'm putting it towards the retirement goal. It's 20 years away. If I put my bonus as a lump sum, it actually doesn't make that much of a difference. But, I would still say divide it over 3 months or 6 months. So for any big amounts that you're looking to put in, you could look at anywhere between 3 months to 24 months of entering the market. Or if you're really looking at very long-term goals, but the lump sum is towards a smaller side, you could look at a shorter time of just a few months to get it. But definitely it's better to, continue investing. What are the indicators that I should realize that my investment is not doing well? And what is the first step I should take? Okay, really good question. I think the first indicator should really be around understanding how is an investment performing in the long term. Because investments may do, and your risk profile and your investment strategy may do a little bit differently in the short term, but I think it's important to look at it in the longer term scenario as well. So if an investment strategy has been working for you, a diversified, I'm assuming we start here from a diversified investment strategy, is working for you over the long term, you can look at riding out any short-term volatilities in it, but always have an understanding of what is your investment return being compared to. So usually the most, common comparison are the MSCI world. So whether you are, if you are in 50-50 equities and bonds or 70-30 in growth and protective assets, you need to look at the benchmark accordingly. If you are in 100% equities, you could just look at the benchmark of S&P 500. Are you doing better than it? Are you doing less than it? So I think it's important to review your investments on a quarterly basis. And the first step, if you feel that your investment is not doing well, the first step to understand is why is it not, where is that underperformance coming from? Because one equity might in the short term not do well, or one sector might not do well. And then you have to ask yourself whether this is within a long-term goal and, are the long-term trends of that sector still positive? It could be something like healthcare sector. In the short term, there might be some volatility, but in the long term, do you believe and do the market indications show that long-term healthcare sector will work? So all of this does require, if you are executing your own investment strategy, it does require for you to keep up to date of the sector or the geographies that you are exposing yourself to. Is buying a car considered an investment? I would say no. It's not considered an investment. It is considered an expense, and therefore an expense that you should manage very carefully as to what is the level you want to spend on it, and therefore which type of car, but also what is going to be the running cost of it. So, you know, whether your car eats up a lot of petrol, less petrol, I think the running cost should be part of it because these are expenses. They are not an investment. The second-hand value of your car is a car. If you sell it, is a cherry on the cake, but you're normally gonna, you know, replace it by another car. So you're not exactly selling your car to then have a return. Unless, you know, obviously you go and buy a vintage car that just sits in your garage and is a is really an investment item, but I'm assuming over here you're talking about a car that you are gonna drive every day. So no, there is wear and tear. It's not an investment. How can we empower women in taking the leap into entrepreneurship and to take advantage of the supportive ecosystem in the region? Look, I think there are a lot of you know, from the DIFC, we work very closely with the DIFC. I know there are a lot of programs over there for women entrepreneurship. But what I would also say is you should look for mentorship programs. I think mentorship is something that it has always been challenging for women to access, but when women have had access to mentorship, it is really a game changer. It really helps unlock a lot of value. And so I highly recommend, you know, I'm aware of some programs in the DIFC region. So, you know, please, from the DIFC, and please do look them up on what they provide for mentorship, especially for women. I think we are coming to an end to the hour. So if there are no other new questions. Great. Then
thank you, Nandini, for such interesting speech, and thank you all for listening. And at the end, we would like to thank you, of course, and thank our guests for their interest and keenness to attend the Human Resources Club event. And we would like to remind you that the HR Club is open and free to all interested parties who are interested in HR and other fields. You can register in the HR Club through FAHR's website, www.fahr.gov.ae. Thank you, Nandini, once again.
Thank you very much. Have a nice evening.
Thank you.